I'm with Karl Denninger, and Karl Denninger has the popular site, the market-ticker.org, marketticker.org. Mr. Denninger has been in the internet, the alternative universe here since 2007. He's got, 6,000 published articles, and he's talking to us today on a variety of subjects. Good to be with you today, Mr. Denninger.
Thank you very much for having me on.
Let's talk about the Greek debt crisis. I don't understand, and a lot of people who read my site don't really understand how somebody can get a 75% haircut and then borrow some more money.
Oh, it's not that hard. You just simply say, I'm going to find some way to hose other people and not the people that are giving me the money. There's a rather interesting little shell game that got played here in that the ECB, which had a lot of those bonds, managed to exempt itself from the haircuts. The IMF, as you noticed, didn't take a loss either, and yet they were part of the funding mechanism for the last couple of rounds. So if everybody else gets hosed but you don't, then it's usually not all that hard for you to go back to the well and get some more money because you protected the people who you were getting the money from. So that's what's happened up until now. The problem comes about in that you now have a bunch of other nations that have similar fiscal situations and employment situations that are in many ways worse. Spain, for example, has a terrible unemployment problem among young people.
Well, Greece does not have a very good unemployment picture. I mean, they're talking a 20% and young people at 50%.
Yeah, well, Spain's is no better. And so the problem you're going to run into now is that these nations are going to go to their creditors and say, well, why should we give you all of the money that you borrowed us when Greece just got a 50% discount? And, oh, by the way, we want the same deal, and if you don't give it to us, you'll get zero. And I expect that that sort of pressure will start to be ratcheted up within the European Union within the next couple of months.
Do you think that, it's the CME group recently requested to not to be taken off the list, to no longer do derivative business as a clearinghouse in Europe? Why do you think they're doing that?
Well, the $3 billion or so of net exposure to Greek credit default swaps is tiny. The danger is that if those other nations turn around and essentially do what I just described, that there's hundreds of billions of dollars of exposure there, and my suspicion is the CME is well aware that the people that wrote those swaps don't have any money, and so push comes to shove, there would be a great deal of pressure for them to cover those bets. They can't afford it, and as a result, why not walk off while the getting is good before things get really ugly? I personally think it's a wise decision for entities that would potentially have backstop responsibility to walk away.
So the CME, I wrote a piece about this, and I basically said that the CME walking away from the European credit default swap market is a bad sign of things to come. Am I way out on the limb here?
I don't think so. One of the problems with the credit default swap market is because we don't force them to be exchange traded and we don't have margin supervision on a nightly basis like you do with index products, commodity products in the general sense. We don't know exactly who's upside down or who's not and who's in the hole to who. And this is one of the big issues. The argument is often made that this is just simply to obscure exposure. It's a little more complicated than that. The banks like the over-the-counter market because they get to hose their customers with impunity. If you can't easily shop for a quote, you don't know whether the quote that you're getting is good or bad.
So why should Americans be worried about what's going on in the European debt crisis, not just with Greek, but the domino, the daisy chain of credit write-downs that could happen with Portugal, Ireland, Italy, Spain, all the pigs, as they say?
The debt crisis in Europe is not just about Europe. In the United States, for example, we are spending about 10% of our gross domestic product every year of borrowed money that the federal government is essentially grabbing from the marketplace of the Federal Reserve and then spreading along the economy. So what this means is that for you as a consumer, 1/10 of every dollar that is spent in the country is not generated by people going to work and making things, whether it be drilling for oil or building cars or cleaning people's teeth or whatever have you. Instead, we just simply say, well, we'll come up with the labor to pay for this tomorrow. And this, to a large degree, is what has allowed us to escape, at least in theory, or so they claim, the ravages of the debt contraction that we would have otherwise seen starting in 2007. So we say, well, that was a really bad recession. Well, in fact, it wasn't a really bad recession. We avoided the pain and put it off until tomorrow. The same thing's going on in Europe. Germany is subsidizing as an export economy all of those people who want to buy Mercedes-Benzes in Greece. And they're doing this by essentially sending money to Greece every year. This is not just a Greek phenomenon. It's happening everywhere. But eventually, the people turn around and say, you know what? We're not able or willing to do this anymore. And that's what happened with Greece, and it is likely to happen throughout Europe and eventually must mathematically happen everywhere.
We're talking about vendor financing, kind of like what Lucent did, and they went down to $1 a share or something.
Almost exactly what Lucent did. Lucent sold a bunch of hardware to Windstar Communications, among other firms, that didn't have the money to actually pay for the stuff they were buying. And it was all just fine as long as they could make a tiny little interest payment. Now, if this happens to sound an awful lot like option arms and home finances and mortgage equity withdrawals, you're right, it is. It's all part of the same piece, and this game must end. The problem is the politicians know that if they turn around and say, we have to pay for everything we want as services. If you take our government and you say, this is what you want from us in services, now this is how much you must pay in taxes in order to get those services, they would be fired the next morning. So we have this disconnect between the size of our wallet and the size of what we would like. As some people say, we have a champagne taste and a beer budget, and that's kind of what we're looking at. So when this contraction and adjustment takes place, it's going to be extremely painful. And what we've seen over the last couple of years is a tremendous ramp in asset prices predicated on the idea that Ponzi schemes and pyramids can go to the moon. And, of course, that is never true.
So here's my question. So the big question comes down to people watching this. Okay, what you're painting is there's some sort of a collapse coming. When?
Time is always the big issue. I could take a look at both the mathematical facts, and I can also look at other people's predictions along with my own. Mathematically, we have a number of walls that we will hit starting approximately 10 years from now. Problem with markets is that they never let you get all the way to the wall and hit it before they say, okay, we see the inevitability of this and we're not going to pay for it anymore. The Simpson-Bowles Deficit Reduction Commission, among its members, it has been reported that none of them believed that we had more than 4 years and that the median estimate was 2.
When was Simpson-Bowles? 2010.
I will note that this was a little over a year ago, which means that the wall is rapidly approaching, and what you will start to see is yields back up in the market. We saw some of this over the last couple of days. And what people need to remember is that when this started with Greece, everything was just fine with their bond spreads and their bond market right up until the point that it wasn't. It wasn't a gradual process where things started to creep up. It was just all of a sudden people threw up their hands and said, we're not going to do this anymore. And the same thing is likely to happen here in the United States.
So give me a time frame.
I'm going to be very surprised if we get through the election, although there are a lot of people that say the powers that be will never allow this to happen, given that it is an election year. I will point out that in 2008 they said exactly the same thing, and you know what happened with Lehman Brothers.
That's right, it blew up. It sure did. And then we nationalized, we eventually nationalized, I think we had the same year we nationalized Fannie Mae and Freddie Mac, did we not?
That's correct.
The trifecta.
And remember how this began. Bear Stearns had 2 hedge funds that blew up in the middle of 2007 in the summer. There was the options expiration surprise in August, which cost a great deal of people an awful lot of money, myself included. Many of us were short, expecting big trouble, and we got blown out of the water by that. And the market went on to rally to new all-time highs in October of that year before it finally rolled over. And then after Bear Stearns, we were told everything, including subprime, was contained and would not lead to a larger downturn in economic, recession of substance. And that turned out to be wrong too.
Yeah.
So, there's the problem with making prognostications like this is that if you look at just the mathematics, you say, well, here is where the wall is. This is about where the market recognizes the inevitability. But what you have to also take into account is that the people that are in power in the government know this, and they will furiously try to prevent it from happening. The problem is that everything that they do actually makes the problem worse, So you get this short-term fix. It's kind of like a drug addict that needs yet another shot. He never knows exactly which one's going to kill him. His doctor will tell him, look, if you don't stop shooting up the stuff, eventually you're going to have a heart attack and die. But he never knows which one it's going to be. And we've got the same situation here, in that all these distortions are an attempt to keep the can, kicked and the plates in the air, if you will. Sooner or later, somebody drops one.
We're seeing the cracks in the walls already. We're seeing an increase in people on food stamps to another new record, 46.5 million people on food stamps. You're seeing the housing market year over year, according to Case-Shiller, down 4%, with what arguably are the lowest interest rates in a generation. We're already seeing cracks, but you think we'll see more cracks between now and the end of 12?
Absolutely, and I think there's a high probability that the ball gets dropped somewhere between now and the election, because when you're in election season, many people's hands are tied. Remember that all the evil things that someone might do, for example, the Kanjorski surprise in early 2009, when the banks were given the right to essentially commit balance sheet fraud as a legal option.
FASB 2009.
If that had been done a week before the election, people would have been run out of town on a rail. Okay, 6 months later, everybody's eye was off the ball because the market was in free fall, and my God, anything that we can do to stop this is good. It doesn't matter whether it actually fixes it. We just need to stop this.
Well,
so that's the kind of thing that happens.
Isn't the stress test a scam? Because those accounting rules, which basically allow banks to value mortgage-backed securities and actual real estate at whatever they think they can get for in the future, they have tons of assets on their books that are worth nowhere near what they're saying they are worth. Isn't the bank stress test a scam? Or am I being too volatile? Am I being too hard on the Fed?
I don't know that scam is the right word, but I would say that given the fact that we don't have any information on exactly what went into those alleged stress tests, in other words, how many, just as one example, how much of this exposure is covered by credit default swaps and therefore considered safe, and who has the money to pay the swaps? Has it been proven that there is actual capital behind these so-called insurance policies that are supposed to pay off, even though legally they're not insurance? No, probably not, but we don't have answers to these questions. And what I continually come back to in situations like this is that the entire point of these kinds of exercises is to build so-called confidence. All right, so it is very important, if you're going to actually build confidence, that all of the facts, every piece of information, all the assumptions, everything else be put out there in front of the public where we can see it, vet it, and investigate it on our own. But that never happens. We're told that they modeled 13% unemployment, 50% fall in equity prices. I will simply note that the Nikkei index was at 40,000 when it topped, and is now trading around 10, which is a 75% fall, not a 50% fall. We had a fall of 60-some% from 2007 to 2009, and during the Depression it was about 85%. So 50% isn't really all that severe. 13% unemployment sounds terrible, but the Depression was 20. And the additional fall in house prices, before anybody thinks that that's excessive, get out your calculator and run the discounted cash flow difference between a 4% mortgage and a 7% mortgage, and then tell me what happens to house prices.
Oh, I've been saying that. On my side, I've been saying, what happens to house prices if rates go back up to 6 or 7%, which is still on the lower end of the curve? And what happens to house prices? They got to go down.
Yeah, just get out your calculator. Take a $200,000 principal, for example. Run the P&I at 30 years on a 30-year fixed mortgage at 4%. Then take that payment, plug it back into your calculator, 30-year note at 7%, and tell me what the principal value of that mortgage is. And that tells you exactly what happens to the price of the house.
Well, the principal goes down, so the payments can go down.
The principal goes down a lot, so the payments stay stable.
Right.
And the change in the net present value of the property is enormous.
We have another leg down in the real estate market. Is that what you're saying?
Real estate has been artificially propped up and priced at a multiple that is unsustainable for 30 years. If you look at what used to happen in the marketplace, we had valuations between 2 and 3 times earnings. which puts the average house price in this country somewhere around $100,000 to $150,000. We're a little above the upper end of that range now on a national basis, but regionally there are a lot of areas that are still considerably above the regional median incomes on a 2 times multiple. And history says that when you overshoot to the top, you also overshoot to the bottom. So it is not unreasonable to believe that in many cases we could see multiples on average home prices closer to 1 times earnings.
So we may fall 50% from here.
It's possible. There's part of the problem we have is that we still haven't gotten away from the idea that you shouldn't have to put 20% or more down on the table to buy a house. And until sane underwriting and actual a $1 capital sort of standard, where you're not borrowing against thin air and a promise to earn tomorrow, but whether you're borrowing against asset valuation, until that comes back into the lending market, we don't know where the equilibrium clearing price is. That has to happen in order to find that equilibrium.
But you definitely think prices are going down from here, not up.
Yes, I do.
Okay. So you think higher rates in 13, Obama president, and some pretty evidently there's going to be a downturn in real estate market too, correct?
I think that there is a possibility we take another run at very low interest rates temporarily. Certainly we've had a breakout recently in the 10-year and the 30-year, for example, and from a technical perspective, they look like they're going to scream higher. There may be another attempt to smash the yield curve, but remember that there is a problem with doing that, and that destroys bank earnings over time. So, and right now they're in real trouble because they've been loading up on these treasury securities that are now going down in price and up in yield, which hurts them tremendously.
Yes.
It also locks the Fed's hands behind its back because it is extended duration, which means now they have to hold to maturity. They can't sell those back into the market or they take a market loss. There is a huge confluence of risks here. Exactly how they play out, I'm not entirely certain. But I think instability and volatility are going to be the things that you can pretty much take to the bank over the next 1 to 2 years.
All right. Karl Denninger, thank you so much for being on USAWatchdog.com.
Anytime. Thank you.
All right.